Hello and welcome to CIO Perspectives. I'm Sid All, the co-CIO of private clients, endowments, and foundations here at Brown Advisory, and I'm joined today by Paul Chu. He's our firm's CIO with a capital C. He built our equity research team in the early years of the firm and eventually transitioned into managing portfolios for families, endowments, and foundations, and he helps oversee all things investment related at our firm. I'm excited to be speaking with Paul today as we're on the cusp of releasing our 2026 asset allocation outlook piece. And there's already a lot of news to discuss in the first few weeks of the trading year. So, Paul, what's on your mind today?
Well, first, Sid, it's great to join you today for a conversation. So as we start into the new year in 26, the longer I've been in my investment career, I'm in my 31st year here at Brown Advisory. So this is my 31st change of calendar. I've started to become a little bit more reflective on how I think about investing. And the longer I've done this, more I realize that relying on what you think you knew is important, that we constantly challenge those thought processes. And for those that don't know, part of my background, I spent an early part of my career as a tech analyst. So I got to live through the sliding up and sliding down of the tech bubble in the late 90s. And that's great from some perspective, but it's certainly at times I have to challenge myself not just to rely on what I think I knew, but make sure that we challenge each one of those assumptions as we start to go up. The easiest thing for me to do is try and say, well, the AI movement that we have today is just like what happened back in the tech bubble. And that's super dangerous when it comes to investing and investing thought process. And so I'm spending a lot of time trying to make sure that I'm looking at everything through the lens of that new opportunity set, because there's a lot going on. We have a lot of ground that we can cover today. Clearly, at the margin, AI is probably the most important investment conversation. That's the most important thing to the investment landscape. But we also have political challenges that are happening. We have an economy that is amazing. It's about the best way I could describe it, because it continues to chug along, even though every moment in time we want to doubt its ability to continue to progress forward. So as we think about that complicated landscape, our job for you and I and all of our colleagues here at Brown Advisory is to try and provide thoughtful investment advice to our clients. And today, like every moment in time, is quite challenging, and there's things that we have to wade through. But with every challenge, there's also opportunities as we think about that. So I'm both excited and nervous at the same time when I think about investing in 26. What about you, Sid? What's on your mind?
You hit on, I think, the thing for me that has been most top of mind, which is just the strength of the U.S. economy, which is staggering, honestly. I mean, the most recent estimate that we've just gotten from the Atlanta Fed, as they try to real time project what Q4 GDP was in the US, their number's over 5%. 5% is a huge number. It's suggestive of a really strong economy. And this would be the third straight quarter we've had of 4% plus growth. I think we've seen some encouraging figures with respect to the housing market also recently, which has been a drag and may be less of a drag, or maybe even add to some of that growth. Mortgage rates have continued to come down. And President Trump recently announced plans to have Fannie and Freddie buy back $200 billion of mortgage-backed securities, which could bring down rates further. Also, hopefully help some of that positioning we have in our bond portfolios where we're overweight that area of the market. Mortgage applications were up 28% last week. Existing home sales were up 5% in December. So we're seeing signs of life in that part of the economy, which has been struggling. It's about 15% of the economy. Retail sales beat estimates in December. We're seeing a 5% growth in consumer spending. We saw a somewhat surprising drop in the unemployment rate in the last readout, just 10 basis points, not a big drop, but maybe we're at least seeing some signs of stabilization there. We get so many questions about how the economy can be strong and also about how uneven it is. I mean, it's definitely this K-shaped economy where the high income earners are doing better than the low income earners. That is real. But we also have to remember that the top half of Americans account for 90% of the income and 98% of the assets, and they're doing pretty well right now. And they're driving the economy and markets. And broadly, wages are rising faster than inflation. Home prices and stock prices are going up. Consumers are earning a decent yield on cash. There are a lot of positives. And the last thing I think about, I've been reflecting on this a lot. You talked about the late 90s and some of the differences. One of the big differences is debt levels, and that's at both the consumer and the company level. But I think a lot of people underestimate what a good position US consumers and companies are in right now from a debt perspective. So the percentage of income that US consumers are spending to service their debt, it's 5% below pre-COVID levels. It's 30% below levels that we saw leading into 2008. Net debt levels for S&P 500 companies, they're 30% below pre-COVID levels. They're 60 to 75% below the late 90s.
So how
So,
are we as an economy at an all-time high in debt if those things are happening?
it's a great question. That was one of the miracles of the 90s, balancing the budget, and it just seems so far away. I mean, there's definitely was a big transfer of debt to government balance sheets. COVID, GFC started it and COVID accelerated it. And that's one of the long list of worries for sure, is that we don't have our government fiscal house in order right now. Maybe that's a good transition. I feel like we got to talk a little bit about the Fed and the recent statement from Jerome Powell. You sent it to me on Sunday. I think my response was one word: wow. For those who missed it, Powell came out recently and said he'd received a threat of criminal indictment from the Department of Justice, and he colored these actions as an explicit attempt to influence Federal Reserve policy. Thus far, markets have barely reacted. I'd love to know what you make of this news, and how worried should we be about this concept of Fed independence?
It's interesting because when you said what I said, you said in the text is that's probably the opening line to most text chains that go around when it comes to investing is wow is usually the first statement because there's a lot of things we've just never seen before. And when I think about this indictment or investigation of Chairman Powell, I think the market has probably accurately reflected what the market impact is. And I think that's what's super important for all of us as we think about investing is we have to all take our political lens off of it when we're trying to analyze what the reality of the situation is. It has as much to do probably with retribution as it does anything else. Chairman Powell's actually lowered interest rates 3 times since President Trump took office for the second time. So the Fed, clearly, it's important that it remains and is viewed as independent. Financial stability, we are the reserve currency in the globe. The people buy our currency and our bonds. Given that debt conversation we just had about how much government debt's out there, we really don't want the cost of capital to rise, which would be one of the negative implications if people thought the Fed wasn't independent. Now, it's important that the Fed chairs one vote. He does influence behavior on the committee, but the reality is it's hard for them structurally to get to that point in time. I think the market's probably been a little more positive, not overreacting to this piece of information because of how the voting structure works. And Jerome Powell has an opportunity to stay on the reserve board, just not as chairman. And historically, the chair, when their term has run up, and his term runs out in May, and you look at this and say, well, why did this happen? Because he'll be out of the chairmanship before anything really moves forward with what's happening. And so I wonder if this may backfire on the president because he may just decide to stay on the board
Committee. Yeah.
as a committee member, and he's clearly got an independent streak to him. And I think the market would take as a very positive sign. So while I don't love to see our administration challenging the independence of the Fed, I don't feel like we've done anything yet that would say that it's not going to keep that independence at the current level.
Yeah. It's one of these things where it's the kind of thing markets won't care about until they do. And I think that's what we both worry about so much is when will we meet that moment? And as you say, if markets do decide they care about this and they're worried about the independence, it could lead to higher interest rates, maybe higher inflation. It's definitely a risk I worry about.
Yeah.
But as much as this administration's pressure on the Fed has that emerging markets feel, the fact that our Fed chair can come out and make that statement is not something you would see in an emerging market. The fact that there is such an open and transparent Fed process, as you say, the committee votes and we see those votes, I think that transparency does something to comfort markets. And one of the reasons that we haven't seen markets react like we're heading in the direction of a turkey, which we wrote about in our last year's asset allocation outlook piece, is an example of what can go wrong when the Fed
Yeah,
isn't viewed
but
as
I think you
independent.
bring up a really interesting point. I keep in the back of my head as I think about investing is a little bit of the boy who cried wolf problem. There's been lots of things that have been thrown out there that on the surface, your first reaction might be, this is really negative to the market. And they're coming at a fast and furious pace. So over the same weekend, the administration put out an edict that credit card interest rates would be capped at 10% for the next 12 months. That has negatively impacted companies that are charging interest on credit cards, the Cap Ones and JP Morgans of the world. But it didn't translate much further, and we just don't know if that can actually move forward. But at some point in time, you got to always think like, when is it going too far? In 25, we almost went too far. So the tariff announcements pushed us to the brink. We finished 25 in a very positive light, but man, it didn't feel that way in the end of March of 25 that that's where we're going to rely. And they quickly backed off that, and the market moved on to the fundamentals of the economy and the big capex cycle that's going on. But we always have to have in the back of our mind that maybe next time it's not. I mean, is this going to be the time that it impacts it? So it does make it challenging from an investment perspective.
Yeah, I was planning to ask you about if you're contemplating any changes in portfolios as a result of this. It doesn't sound like you are, but just more generally, how are you positioned with regard to interest rates, duration in your bond portfolio? And I guess I will ask, would this have any impact on that?
Yeah, it's important. You think about why do you own fixed income in your portfolio? And for a lot of our clients, it could be many different reasons. It could be income generation, it could be a little bit of negative correlation to your stock portfolio. So it's important to think about what's the reason that you have that fixed income within portfolios. And you add into this conversation, equity markets have done incredibly well. Credit has done amazingly well. So we're at very, very low credit spreads in both high yield and investment grade credit. And bond investing is an asymmetrical investment outcome. So you can earn your money back with interest paid. But if you're wrong, you can end up at zero. So it's not like you're going to double your money on the other side. You got to be very careful about what you're paying from a credit perspective. And so credit spreads leave very little interesting opportunity set today from my perspective. So we've always tried to keep duration on the shorter end, but I think we're starting to contemplate, does it make more sense to have the diversification benefit that having a longer duration in portfolios would make sense? So to me, it's a little bit of, I'm probably moving a little bit away from credit and moving a little bit more towards duration and bond portfolios to get that from that perspective. But when I think about my portfolios, I'm probably not making huge changes. I'm leaning more heavily into managers that have a little bit more of a broad mandate to be able to navigate, which I think is a market that's presenting opportunities not in a uniform method. And to make big asset allocation decisions, I need big dislocations amongst asset classes. And there's less of that today, but there's still within asset classes a lot of divergence that I think present opportunities for people that are nimble, that have fundamental processes that can identify those opportunities and really capitalize on them. So if I flip it over to you, when you think about one of the questions that I get asked a lot in portfolio meetings, I'm sure you're hearing a lot, is given all of the stuff that we talked about with the Fed and challenges. One of the assets that did incredibly well last year was gold and silver. Is there an opportunity there? What are you looking at when you think about that?
Yeah, gold is such a tricky one, and we've definitely gotten more and more questions about it. Off to another strong start this year, and I feel it's been a long time since you and I have talked about silver. We talked about it a lot, even the great financial crisis era for a while there. A lot of investors add gold to portfolios for inflation protection and diversification. If you run an analysis over long periods of time to maximize the risk return of a portfolio over a long period of time, a machine will spit out an answer that says that it's very additive to portfolios. But some of the issues that we have, it has no intrinsic value, it produces no cash flow, and it can be subject to really long periods of time where it loses money, like 20-year periods of time where it's dead money to you. And coming out of the financial crisis, we experienced one of those where until very recently, gold had done nothing for you. One of the ways that I think about valuing gold, I mean, really one of the only ways that you can is the price of gold relative to the cost of mining it. And if you look at that today, it's the highest we've seen for decades. So we're like 3 to 4 standard deviations expensive on that metric. So if you say kind of in normal times, I struggle a little bit with gold because of what I just talked about. And we prefer to be invested in great companies or assets that produce cash flow, or they eventually will produce cash flow. I probably feel today even more strongly about that preference given how expensive gold appears to be. So I'm totally prepared to be wrong on that in the short and the medium term. Investors and central banks are definitely moving capital towards gold. And given that it has no intrinsic value, it kind of trade wherever people want it to trade, whatever price they're willing to pay. It's just flows and supply and demand right now. But I think as a fundamental investor, it's still been something I've been reticent to add to portfolios.
And I did say earlier to be skeptical of what history tells us in analyzing something, but if you look historically, gold has not done well when miners increase capex. And with the ratio that you just laid out there, I think people are expecting a 30% increase in capex in mining. So when it's that
Right. They should
profitable,
be increasing. I mean,
yeah,
if you're going to get a 4x premium for the price relative to the cost of mining it, you should be building a lot more mines. And eventually that supply response should lead to declining prices. And it's just a question of when. It's a tough
great.
one. Maybe we could switch gears and just talk about benchmarks. You and I have been talking about benchmarks a lot. And I was hoping you could share some of your thoughts and observations about the benchmarks most investors use, how they've changed in recent years, how can they be useful, but also how can they lead us down the wrong path?
Yeah, this has been a topic that you and I and everyone here at Brown Advisory spent a ton of time talking to because you go back to the very first benchmark that was created by Charles Dow with the Dow Jones Industrial. The purpose of that at that time was actually to mirror and give people an idea of how the economy was performing. It wasn't about measuring how stocks were doing. It was about measuring how performance of the economy was happening. And then years later, S&P came into the world and started creating market cap weighted indexes versus the Dow. It was price index and then MSCI and later Frank Russell in creating style benchmarks. And we've had moments in time where certain sectors, whether it's in the Nifty 50 age, or if it was in the tech bubble or financials prior to the great financial crisis, where one sector is doing particularly well economically, and they take up a bigger proportion of the index. And that has implications. And today we've gotten to a level of concentration and benchmarks that we just haven't experienced in the past. And I think an important thing to think about with that isn't necessarily is that a bad or a good thing. I'm not going to judge on that, but there is an implication today that's very different than in the tech period prior to the financial crisis and in the Nifty 50 is that passive makes up so much of the investable market today as people can access indexes through ETFs and index funds. That leads to when you have concentration, every time people put money into a passive index, they're buying more and more and more of the big stocks. And in small cap land, passive makes up more of the ownership of the index than does active managers. And so it's all about capital flow in that. And so I think it's important. Concentration is becoming a self-fulfilling problem on the upside because as the stocks go up, more people move into passive, the more they take and buy more of that. We use benchmarking for a lot of different things when you think about how we think as investors. It's a way of judging success of an investment manager. If you hired them to do a certain asset class, global equities, you would compare them to the index to make sure that they're executing effectively on that. That gets super difficult when indexes get really concentrated because most managers are going to be a little bit different than that. And with all of the money that's in passive, it's made it a really difficult period from an allocator's perspective to evaluate success or failure of managers. Where it becomes problematic is you hire an investment manager, you believe in the people, you believe in the process, and you believe that's the way to succeed is to follow that process. If they start fixating on the benchmark, it can start to change behaviors. And that's where it gets problematic from our perspective is you don't want the benchmark to change how you're doing what you're doing. And it's important for us when we are working with clients to make sure that we understand what our objectives are. I never sit down with a client and say, my objective is to produce excess return relative to the benchmark. I hope that's an outcome that happens, but it's not necessarily the objective. The objective is to get a certain level of return for a certain level of risk that we're taking. It may be about income generation in portfolios. I always use this analogy, and it might be great. People might not agree with this, but when we all went to college, we went with the idea of trying to obtain skills that would get us to be successful in a career. Our objective was never to get a 4.0. That wasn't the reason you picked your major. And we may have made different decisions on what major to pick. We use GPA to evaluate whether we've successfully attained the skill set that we need for that. And so relative performance to a benchmark to me is sort of like the GPA. It's evaluating the success of that, but it wasn't the objective. And when the benchmark becomes skewed the way they have with concentration, we have to make sure that we're thinking about the objective still of certain level of return for a certain level of risk. And I think that's where benchmark investing in passive today, and I would love for you to comment a little bit how you think about passive investing in a world where the benchmark has changed because the risk profile has changed from that. So how do you think about it, Sid?
Yeah, I think it's a really challenging time right now, given this market concentration. We already talked about it, right? It is historic. This is uncharted territory for the concentration of the market. These benchmarks used to be diversified portfolios that represented all the sectors of the economy, companies. They were not equally weighted within the benchmark, but I mean, it used to be 15% in the top 10 holdings, and now it's 40. And those companies, because of their volatility, the risk that they represent is even greater than that. And today, they're increasingly in one large concentrated bet, which is surrounding now AI, the infrastructure, the cloud, so on and so forth. And look, honestly, there are elements of that bet that I really like in the near to the medium term. But by no means are benchmarks today diversified or what they used to be. So I guess I would strongly warn people against getting 100% of their risk allocation through a single index with that level of concentration. And I think we as investors and people who pick managers internally and externally need to probably be a bit more patient than we used to be, because these benchmarks are getting less useful at comparing near-term performance, because it's just all about how are a handful of stocks doing versus what's the average stock doing. Or as you say, like an absolute return. If we are underwriting stocks or our managers are underwriting stocks and saying, I think this can generate a 10%, a 15% underlying return because the business is growing and their margins are going to expand and so on and so forth. And they're like actually hitting those targets, but they're not beating a benchmark that is dominated by a handful of companies. We shouldn't necessarily penalize them for that. especially if their approach is to be more diversified. Because I think we have to remember that much like after the late 90s or in the 60s with the Nifty 50, like there could and probably will be some period of time where, as we've said in the past, like the rest outperform the best. The equal weighted market outperforms significantly. And that may not be this year or next year. We don't know, but it's kind of inevitable that is going to happen. So if we want to build diversified portfolios, we still use passive in portfolios, but it's the minority of the portfolio. It's not the majority of it. I'm curious, how do you use passive linked investments in portfolios today?
Yeah, I'm in the same camp. So we use a little bit of passive almost as a core portion of the portfolio. But what I have to be cognizant of today is that the risk profile of that passive, where 10 years ago was fairly diversified portfolio and not stuck to one essential theme with AI, that the risk profile has changed. So if I'm thinking passive was at one point in time the thing that allowed me to take more risk in other parts of my portfolio, I have to rethink that a little bit because the passive isn't as risk free or less risk as it is today. And so I think a little dive into one stock just to talk about. So NVIDIA is the largest position in the S&P 500. And we need to think about generating returns for portfolios and do that. To believe NVIDIA is going to continue to produce that, they've had phenomenal growth. The business fundamentals seem outrageous for the company. Just to put some statistics in that I was looking at earlier, gross margins for NVIDIA in 2014 were 55%. In 23, they got to 57. In 25, they're 75%. Free cash flow margin over that same period in 14 was 14%. In 23 was 16%. In 25, it cut to 46% free cash flow margin. That's a phenomenal business. But that's history. To make money in the stock, we need to underwrite that that's going to continue into the future. And if that is a largest portion of the index, that's what you're buying and underwriting when you have a large portion of your portfolio in passive today. And that may end up being great for the next 3 years, 5 years, some period of time, because the AI train is quite extraordinary right now. But it does change the risk profile of what you're investing in. So I almost have had to, if we're using passive and am using passive, be more cognizant of the risk I'm taking outside of that portion of the portfolio.
It's wild. The index today is more concentrated than most active managers are willing to be. And in fact, it's broken the rules of the diversified fund rules for mutual funds. The people are having to change the type of mutual fund they are because the market itself no longer qualifies
By
as
the
being diversified.
SEC rules,
Yes.
you cannot run the Russell 1000 Growth Index as a diversified portfolio.
Yeah.
The index that's supposed to have hundreds of stocks in it.
It's really interesting. As concentrated as public markets are today, sometimes it feels like private markets are following suit. I mean, certainly in the VC backed market. In fact, interesting enough, it might be more concentrated. So I was going to run some rough numbers for you here. It's hard to know what the total market value is of VC backed companies in the US, but somewhere maybe it's 4 trillion, maybe it's 5 trillion. After the recent markups in just a few companies, SpaceX, $800 billion valuation today. OpenAI, rumored to be also over 800 billion at a new round. They just did it at 500, and right before that it was 300. Anthropic raising it about 350 billion. Just those three companies would make up 50%, or depending on what you think the number is, 4 trillion, 5 trillion, 40 to 50%. Three companies of venture-backed companies. What do you make of these valuations, and how do you approach VC investing given this level of concentration?
Yeah, it's a great question because if I'm analyzing a public company, I can go out to the filings, the information is readily available, we can underwrite for what they've done, we can make some projections of what I need to assume in the future to try and get to that point in time to make a case that I can make certain amount of money. I always think about private venture investing as I'm looking for multiples of return on the capital that I've put in. And so if I think about investing in a company like SpaceX at $800 billion dollars to get to a 2x return, that's a $1.6 trillion company. It'd be one of the, six largest companies in the United States, probably one of the top 10 companies in the world. That's an extraordinary world that we've just never done. As a public market investor today, I don't have access to see exactly the underlying numbers that they're using. We will see those soon because the rumor is that they're looking at filing for IPO to be able to get there. On the flip side, when I think, how do I deal with that as an investor? I can't tell you if I think SpaceX is a good value or a bad value or a good opportunity at this point in time. But what I can tell you is that there is some companies, those three that you listed, throw Databricks in there. There's some really amazing businesses that sit in private markets today that are changing the world. And for my clients, for myself, I continue to invest in venture for the opportunity to have done that. It's a completely different game if you're going to ask me, am I going to buy SpaceX today? And I'm going to need some more analysis on what the opportunity set and how that can move into the future. But I do think that it is amazing the size and scale. You want to see what gets me excited is the entrepreneurial mindset of the United States is phenomenal. To think of the companies and businesses that have been created over the last 10 years, the last 5 years, it's extraordinary. And I want my clients to be part of that. So we continue to allocate into that space. Now, is today the great time to do it versus 3 years ago versus 5 years ago? You never really know that, but our approach has always been to continue to allocate to that part of the world so that when you do hit these cycles and you get these investments, and a lot of these investments are in a lot of our client portfolios through funds that we've invested in, we didn't know the opportunity set, and the managers we invest with 5, 10 years ago when they first invested didn't know it was going to be this. But that's why you continue to invest in privates.
Yeah, I agree with so much of what you said. And a lot of the complaints as valuations started to go up at the earlier stages in venture capital as people were looking at what the old outcomes used to be, right? $1 billion outcome was an exceptional outcome. The math changes when you see that there can be outcomes that are $100 billion, $300 billion. It makes you a little bit less sensitive at the earlier stages to what you're paying if you have these enormous markets where it's kind of winner take most. And so I definitely think about that as well. I also just think about even with some of these later stage companies, and we have exposure to people who did the last Anthropic round, and they're probably going to do a bit in this Anthropic round, and OpenAI and so on and so forth is hard. These companies are staying private for so long, and they're the leaders in some of the most interesting and fastest growing parts of the market. And if you have just no exposure to them, that ends up being a hole in your portfolio as well. So it really is a tricky one. I would say one thing I have definitely tried to remember over time is that I've typically tried to keep venture capital to be a minority of our private equity portfolio. And this is another thing people need to keep fresh in their minds coming out of that 2021 period where managers were coming back really quickly. And then suddenly, oh, whoops, I've put 75% of my allocations this year in venture, which a lot of people did. We did not do that, but it's hard to remain disciplined. It's a risky asset class and it's getting increasingly long duration. It's cyclical. An uncomfortable truth about the asset class is that the median venture capital manager is not a good investment. Whereas, the median buyout manager or growth manager typically gets you at least a public market like return or a little bit better. The median venture manager will actually underperform the market and take a really long time for you to get your money out. So you got to be in those top managers too, which I think we try really hard to be disciplined on. Manager selection is just so important. So there's just a lot of things I think to keep in mind here, including, as I mentioned, the sizes of the outcomes have gotten bigger. These are companies that we're not getting access to if we don't have some participation in the later stage, but then just trying to remain disciplined because I'm getting a little bit of that 2021 feeling right now where managers are starting to come back. And so I think the playbook is got to re-up with those top managers, but just be conscious of sizing. How are you just thinking more broadly about privates right now? I know you were a supporter recently of a recent partnership that we had with BDT MSD within private credit. You just talked about, and we both agree on this kind of importance of disciplined annual commitments. But what are you focused on in the private world for 2026?
Yeah, and credit's an interesting one because credit has probably of all the private investment asset classes been the one that's been most influenced by the movement in evergreen structures. We hear a lot about the democratization of private equity down to more retail investor flow, and private credit's been at the forefront of that. So we've seen some enormous funds raised over the last few years, and we've gotten the more capital in a market tends to start to bring out some not great behaviors as people are competing for deals. In the fall, we had a couple of high profile credit blow-ups that spooked people a little bit. And private credit falls into that same fixed income conversation, right? It's an asymmetrical return. I can get really attractive yields, but I got to make sure I'm getting that 100% principal back at the end of the day. So what I was really attracted to with the BDT MSD opportunity in private credit was a couple of things. One, the team itself, this is a team that was started inside Michael Dell's family office. And they have a mentality that was really about putting capital out for Michael Dell and being very conservative. Their underwriting is, in our mind, one of the best in the business, and their statistics would hold up to that aspect of it. They were allocating capital with the mindset of not losing money. And I think that makes a ton of sense. Two, it's a de novo portfolio. So we're not buying into credits that were underwritten 3 years ago, 2 years ago, when it was a little bit more of a feeding frenzy on what deals you would get. Three, as we've seen those high profile deals start to blow up a little bit, the opportunity set's going to improve for us as they put out capital. So spreads hopefully will move back out a little bit. So I view this in a lens of it's pretty manager and opportunity specific within this, but from an asset allocation perspective, it's a very useful tool when I think about what am I trying to deliver for my clients from a return perspective. So we're underwriting high single digits, low double digits, net of all fees type of return in an environment where equity valuations are a little high, fixed income, we got 7+% out of taxable fixed income. That's pretty hard to think that's in the cards for us to repeat on a forward basis. So there's a different risk profile, different liquidity profile that's coming out of private credit, but it's a super important tool for allocating capital in today's world.
Yeah, I mean, when you look at just a 10, 11% yield today on a portfolio like that, and you compare that to our long-term return estimates for public equities, which are meaningfully lower than that, you're certainly taking more risk than you are in treasury bonds, but you're taking less risk than you are in equities. And so I think that asset allocation piece still stands. And if you're funding it partly from equities and partly from fixed income, which we typically are, I don't mind that trade-off at all. What are your thoughts on international equities for 2026? Last year was the first big year of outperformance we've seen in some time. Valuations did rise more outside the US than they did in the US. So earnings didn't quite keep up with that outperformance. But arguably, markets like Europe and Japan are still cheaper than the US. How are you approaching international markets and diversification this year?
Yeah, in 2025, I'm glad I had it in my portfolios. And it was much easier if we were sitting here doing this at the end of 24, it was a much easier decision. Valuations were low, currency was sitting on its back, and you had the upside potential there. Today, we've seen the currency come back a little bit. You've seen valuations lift quite a bit. So it's not a simple asset. The only part of international right now to me that's still a pretty, I wouldn't never use the word easy, but it's a little more obvious investment case today is in Japan. There is a continued movement of profitability. Valuations are a little bit lower than some other markets. So continue to very much lean into Japan and international. International in general to me is much more about the specifics of the manager and the opportunity set. I think the opportunity set's there, but I want people that I wouldn't be looking at international purely on a passive basis right now. I think it's a landscape where if I have high conviction managers, I'm going to continue to allocate capital. I want them to have more flexible mandate to take advantage of that, but continue to think it's an important allocation from a diversification perspective, offsetting. When we say diversification, it's not for the sake of just having something different than the US, but the types of businesses that can be bought in Europe in a growth portfolio tend to be more industrial. They tend to be more defense contractors versus the US, you're getting tech heavy. So you're getting different types of businesses. And that to me is great in today's day and age.
Yeah, agreed. And if we're talking about how concentrated the market is in a couple of stocks in the US too, right? That filters through. If you're US overweight and you have some of that through passive, then you have that concentration. And if you look back over 30 years, I mean, the US is at a peak in its representation of the global indices that you might be looking at and comparing yourself to at 66, 67%. But over 30 years, that average is more like 50, 55%. And so I think that's something for people to keep in mind as well. What about small cap stocks, Paul? We're off to a good start in 2026, outperforming the S&P. Today is the 15th of January when we're recording, but outperforming the S&P by 5% the first couple of weeks. Are we finally seeing market participation broaden out a bit?
Yeah, and small cap's such an interesting one. As an overall asset class, when you aggregate the together, valuations are definitely attractive relative to large caps. But both in value and in growth, there's pretty big sectors that you have to have a thought process on, right? In growth, it's very much about biotech has gone from about 4% of that index to close to 15, 16%. Banks are a super important part of value investing. But if I take the conversation to the very initial part that you and I talked about was this idea that the economy is fairly resilient in decent shape. We have an accommodative Fed. Those are usually backdrops where smaller companies can do better than larger companies. Just in an aggregate sense, they're a little bit more cyclical. They tend to be a little bit more leveraged. When rates are coming down, that benefits them on the leverage side. So the environment seems to be favorable from that perspective. The one downside is that they're not as AI centric from an index perspective as the larger cap indexes. And so it doesn't mean that there's not AI exposure within small companies. So there's industrial companies, there's lots of companies that are benefiting from what's going on. It's just not at the epicenter of what draws people's attention. So they fight a little bit of the capital allocation problem, but it's probably an asset class underweighted in most people's portfolios. So the minute you get some good information and momentum in earnings, I think you'll continue to have good returns this year.
Yeah. Well, fingers crossed this is a year where we start to see that broadening. Just at a high level, if we just summarize putting all this stuff together, high market valuations, record levels of market concentration, but a strong economy, and then the concerns we talked about, Fed independence, the riskier phase of this AI CapEx cycle, inflation deficits. What is just your message right now that you're communicating to clients?
Yeah, and there's one word that you and I didn't use in this conversation that I hear a lot and get asked a lot about, which is bubble. And I think it's really dangerous to use that word and use that mentality because it's just too easy to think that, oh, this is a bubble. Back to we like to equate every scenario to every situation that's out there. We have to evaluate every company and every opportunity based upon the fundamentals that we see and the opportunity that we see in the future to evaluate that. And I don't think that we're in bubble territory in AI. There may be individual stocks that have gotten to the point in time where they're over reflecting what the opportunity set is. But I haven't gotten to the point in time where I think it's irrational when we look at some of these companies. And if we went back to NVIDIA for a second, that company's valuation actually keeps coming down. It's not gotten more expensive, it's gotten
Yeah, it's like
cheaper over
26
time.
times forward earnings or
Yeah.
something. Yeah.
So to me, the valuation on NVIDIA happens to be around, do you believe that the margin structure can stay where it is and the growth can stay where it is? That's why the stock's going to go down if those two things don't happen. It's not because the stock is expensive from a valuation perspective. It's super important to keep that in that context. So it's a very investable market. I think we have to be very nimble about how we approach it and not be dogmatic about those. Look for specific opportunities, a BDT where we can put significant capital in and feel very confident about what the return outcome is. A Japan. Japan was a really positive investment case that we made that has benefited client portfolios, and we feel that we're in the early innings of that opportunity set. Until we run out of places to redeploy capital when thinking about the world, I still think it's a decent backdrop. All of the things that you laid out, I think, augment that we will see fairly high volatility amongst markets. And capital markets have evolved. The amount of capital in passive definitely makes things more volatile. Those are great for people like you and I, right?
Hmm.
If you can move capital into the market when it's flying out, as long as the fundamentals continue, you can make some good returns. Those people that were putting capital to work in the beginning of April had a really good year.
Yeah, it's really endlessly fascinating to me that after this run that markets have had the last few years, that when we sit down with our concentrated stock pickers, both inside the firm and outside the firm, that they will talk about this still as a really attractive investment environment for finding bottom up ideas. And some of that is because there's all sorts of stuff that's left behind when markets crowd into the indices. You
You
know,
and I have a manager on the West Coast that we really like and respect. I think their underwritten IRR of the portfolio is over 20%, which is the first time in their 20 plus year history of running the fund.
yeah, you can look bottom up stock by stock and come up with that underwritten future IRR. And look, those are guys that focus on more mid cap stocks that are very much left behind in this market environment. Yeah, I think there's plenty to be excited about. Let's close with a lightning round. I did this on the last conversation with your buddy Sarge, and we asked what excited him most about 2026 and what maybe one surprise, positive or negative, you could think of for markets this year. So, what do you think? What excites you most about this year, and what's a surprise that the market might not be pricing in?
Yeah, I think back to the last comment, what excites me the most is that there's still plenty of places to put capital. So BDT, Japan for me are two that sit at the top of my capital allocation decision process. And so I think one of the surprises, and you and I haven't talked about this, and we don't have enough time to really get into this, but this may draw me back a little bit into my days when I was a tech analyst because I covered software companies. I think there's an interesting opportunity that's happening in software, and I think we're going to end the year. Not every company, but right now, the market has determined that semiconductors are great and software is dead because of AI. I think by the end of 26, we are going to differentiate amongst those two, particularly within software, and say that not every software company is going to be eradicated by AI. And there's going to be some amazing investment opportunities that present themselves. I was looking at the difference between the SOX, which is the semiconductor ETF, and the software ETF. In the last 3 months, the return differential between those two in ETFs is 30%. I
Hmm.
mind you that the number one stock in the software ETF is Microsoft, and number two is Palantir. That's
Yes.
crazy.
Yeah. Palantir's one that's been able to avoid that
What about you?
classification as a loser.
What are
Well,
your
yeah, I'm sensitive to the fact that I hit a bit on this in our last podcast. And I actually did call out also, I'm a believer that we're going to have 4 more quarters of earnings in these software companies. And every one of those is an opportunity to remind people we're not dead yet. And
yeah.
the valuations just keep coming down. These are businesses that are compounding their intrinsic value. They're growing 15, 20, 25% per year. And when the price goes nowhere or goes down, the valuation comes down really quickly. And I think the more they get an opportunity to show that their business is doing okay, and oh, by the way, they might actually have some AI applications because they are very active users and they're building all sorts of upcharged products that will use AI. It may end up being a really interesting buying opportunity. I'm also excited about just the next phase of AI winners and whether that's within the infrastructure area like high bandwidth memory, which has taken off this year, or other areas of the supply chain. I think that's interesting. But the real economy businesses getting an impact from AI, you talked about industrial companies. I think we spoke about and we're writing about in our Outlook piece, C.H. Robinson coming out and talking about 600 basis points of margin improvement from utilizing AI. I think we forget that what the AI guys are pitching you is that this is not tech anymore, it's the whole economy. Well, guess what? Then the whole economy and companies in lots of different sectors and industries should be benefiting. And I'm excited to see more of those benefits this year. I called out on the last podcast and we talked a lot about today. I think people might just be surprised at the strength of the US economy and that a renewed cyclical strength of the economy will broaden out some of the winners, small caps, housing, and real estate. It could be surprising to people if this economy is going to grow at 4 or 5%. And I, by no means, am predicting that for the entire year. But if we keep up at this pace, it's inevitable that there's other stocks with more sensitivity, more torque to that economic growth than just the big cap tech stocks. I think a surprise that I didn't talk about on the last podcast might be that inflation surprises people to the downside. And this is not a popular opinion. I think there's a lot of expectations that tariffs, we may see ongoing impacts from tariffs, and who knows what new policies may come out. But part of this is just demographics. The global population is growing slowly. In the US, we've slowed our immigration down to a trickle. Part of this is about AI, increasing productivity, bringing down costs of business. And then part of it's also about China exporting deflation to the world. China recorded a record $1.2 trillion trade surplus last year.
I would add
So,
one more thing to that, Sid, which is CPI is calculated on a year-over-year basis. So once you add tariffs in there once,
yes,
unless they're going to increase the tariff, it's actually going to be a flat
great
contributor to
point.
next
And
year.
we're recording this before the expected Supreme Court decision, which
Yeah.
may be striking tariffs down. I'm not convinced that will be the end of that story, even if it does occur. But you're
I
right.
like that prognostication.
Yeah, that's a tough bet. I'm not on poly market trading that right now. I will tell you that. But they're flooding the market with electric vehicles, robotics, electronics, solar panels. And even though Americans are buying fewer Chinese goods, I think we were down 30% in our imports from China last year. The rest of the world's buying a lot more. And that just kind of works its way around, I think, in a way that will put some more pressure downward. And another surprise maybe is just there's all this talk about an AI bubble. You brought it up. People might be surprised that spending actually just continues to increase because if AI is successful and we start seeing more return on investment, if we're in the second quarter and Meta and Microsoft and some of these big tech companies are saying, actually, our budget's going to go up by 5%, I think that will surprise people, but I think it is entirely possible. With that, I think we should probably wrap it up. Paul, this is a great conversation. Thank you so much for taking the time. Thanks everyone for listening to us, and we'll be back with more conversations as the year unfolds.